do we have 10 years of flatline, like to catch up, or maybe 5 years of flatline? Very slow growth. By flatline, I just mean 0 to 5% growth versus 20 plus. Daryl Dyke. Daryl is an entrepreneur and real estate finance expert with 26 years of experience. He owns Noble Mortgage, an investment lender that offers both hard money and conventional financing. In 2021, so last year, he actually founded the Legacy Insurance Advisors. How you doing, Daryl?
I'm good. How you doing, Chris?
Doing good, doing good. So for this hour, we've been talking about the housing market, possible looming recession sometime in the next 12, 24 months, interest rates doubling. What are your thoughts there?
Man, that sounds like a lot of bad news.
It's news, but yeah, it's definitely it's spun as bad, but it's news. What are your thoughts? I don't know. Is that good or is that bad?
I mean, inflation right now is the enemy. So that's what they have to get a handle on, which is obviously what is pushing up interest rates right now. So interest rates have slowly been pushing up. As far as how that affects real estate, I think it's going to slow the market down a little bit. It's going to push some buyers out of being able to afford anything, which is already an issue. It's also going to downgrade some buyers from maybe looking at a certain price range of home. What I always look at as a lender, and especially as a hard money lender, is that move up market. That move up market is typically, I consider, like 600,000 to $1 million. And that's someone who has done well financially over the last couple of years, and now they're looking to upgrade from a $300,000 or $400,000 house to a $600,000, $800,000, $900,000 house. So that market is always the soft market in my mind whenever the rates move up. So I think it's going to affect that market a lot. Anything over $1.5 million or so, it doesn't really affect it that much. But lower income also, we have a major affordability problem across the nation and all across Texas right now. And rates moving up is certainly not going to help that, but it will help inventory. Inventory has been a major problem. Houston is, I think, 1.4 months, 1.3 months right now. So that's always an issue.
So what do you think about this? I've been saying we've had 10 years of like it could be, I don't know if this is true, but definitely over the last 100 years, this has been like the best time to ever be in real estate.
Yeah, absolutely.
And now it comes off the cuff of the worst time to be in real estate, which was 2008. But so we got 10 years of really, really good times. So over the next few years, I mean, with inflation, because I've read different reports, even from Fed managers, different regional managers are saying like this is crazy. The Fed's not doing enough. Like they need to be doing like 3 times what they're doing, which is insane to think about. Do we have maybe 10 years of it, even if it doesn't, we don't actually have a recessionary pricing, which I don't really see. I see some people talking about that. Do we have 10 years of flatline, like to catch up, or maybe 5 years of flatline? Very slow growth. By flatline, I just mean 0 to 5% growth versus 20 plus.
Yeah, I mean, I think it's certainly going to affect the appreciation. Look at especially the last 3 years, the appreciation has been insane. Especially from an investing standpoint, it's dangerous. I mean, it's good for the market. It's dangerous for investors because it turns investors into lazy investors. And what it does is it allows you to make a mistake on a flip or whatever it is you're doing and still make money.
The market will help you out.
Yeah, and so it also makes investors more aggressive because now they're betting on they're betting on that appreciation. So I think it's going to slow down a lot of that money going into the market. As far as appreciation, I think it will slow it down. Inventory has been one of the big factors that has caused appreciation to elevate so rapidly. Mm-hmm. So I could certainly see a flat line. You could even see some markets moving down. Maybe some outlying markets that have been affected by the low inventory. You have a lot of investors that have moved into, maybe not in the major metropolitan areas, some of the smaller counties outside these major metropolitans, and even maybe some of the suburbs of major metropolitan cities like Houston and Austin and Dallas and so forth. I think those typically get affected first. Inner loop areas, inner city areas, you typically don't see a lot of depreciation. Maybe we'll see slower appreciation, but I don't see anything as far as a rapid depreciation.
Yeah, and ultimately, I think cash flow becomes even more important because if you're not going to be making it on appreciation, which I mean, you have two. You've got cash flow, and then you got appreciation. That's ultimately, I mean, excluding equity gain and tax benefits. Those are really the two main ways you're making money as an investor, or as a homeowner. It's more, I guess, savings versus rent, and then appreciation. So that means cash flow. Like if you're not buying for cash flow, you're putting yourself at real risk in the event of appreciation flatlining or even receding a little bit.
Yeah, I mean, if typically you're betting on one or the other. You very rarely do you get both appreciation, at least rapid appreciation and cash flow. But I think a lot of investors have seen that the last 3-4 years.
So, yeah, it's been really glorious times for landlords. It's been
absolutely
tough for a lot of folks, but
yeah, the value of their properties have gone up a lot, and they're getting good cash flow. I think the cash flow is really what's going to get pinched the most in the coming months, because as the rates are moving up, the rents haven't been able to move up quite as rapidly. I think we're going to see a lot of rent increases in the future, but certain markets are not going to be able to keep up with that because you have affordability issues. So I think if you're an appreciation investor, you're always going to be fine because the market's always going to eventually appreciate over time. Cash flow, you're going to have to be a little more selective about which market you're in.
Yeah, some of the advice and let me know what your thoughts there here. For investors, I've been telling folks, like, look, if you're buying to flip, you need to be a bit more cautious. Like, you need to be very, very stingy on your numbers, and maybe even add for some X factor that you don't know, because the market has been forgiving for bad projects. But if you're buying long term, the worst thing that can happen is you got to put a little bit more money down, and that'll cover your cash flow problem. Because typically rents you don't necessarily see a receding in rents. You definitely can. It's not impossible, but at least in maybe not in the New York area and those kind of areas. But usually, as long like over time, it fixes itself. It will appreciate. Rents will go up. So it's mainly just your initial debt service that maybe you just got to put a little bit more money down to make sure it cash flows.
Yeah, that's one way to do it. And you also, when you're looking at a rising interest rate environment, or when you're possibly looking at a recession, if you're flipping houses, you need to be thinking about multiple exit strategies. Multiple exit strategies can help out a lot. You have to have that mindset. Maybe you're not able to flip that house for what you thought you were, and maybe it ends up on the market a little bit longer. So you need to figure out what else you can do with it. Do you just keep it and rent it? Do you own or finance it? I mean, there's all kinds of different ways to create cash flow. And that's what you're going to have to do if we do hit a recession and the real estate market takes a hit.
Which is precisely why I tell folks that are buying Airbnbs, short-term rentals, like, look, you're buying this and that's your only exit strategy because you're paying retail and it does well as an Airbnb. Great. But your problem is if it doesn't cash flow long-term, because maybe a COVID situation happens where you can't short-term rent it, or you get saturated and the short-term rates, plummet, you're in a bad spot. Now your only exit is to sell it. And can you sell it for a profit?
Yeah, if Airbnb is your only exit and you're banking on that type of cash flow, because you make a lot more money on Airbnb, if you need that type of cash flow, that's certainly a dangerous spot to be in. Multiple exit strategies are everything. You look at them. I started my company in 2003, so I went through the Great Recession of 08 and 09, and as a hard money lender, you get foreclosures from time to time. I don't get that many. I get between 0 and 3 a month.
Yeah.
I mean 0 and 3 a year. But in 08 and 09, we took back a lot of properties, and so some of them, well, quite frankly, we couldn't even sell. There was no buyers in those markets. And so I had to get creative. We always try to sell it immediately. We're not in the market of holding real estate, but some of these houses that we had loans on, unless I wanted to just take a beating, I had to figure something else out. So I owner financed some, I rented some, and I held on to them for several years and eventually liquidated several in, I think, 2017, 18. And then I liquidated actually the last two last year. So you just hold it, if you're upside down.
Did that turn them all around?
What's that?
Did that turn them all around?
Oh yeah, absolutely. I mean,
Yeah.
you sit on a piece of real estate, eventually the appreciation is going to catch up. So
It'll always catch up with your mistakes. I mean, really, the only X factor is if it's like just a money pit because it's so old.
yes,
But I guess then, eventually land prices, but that's a different equation.
yeah. No,
Okay,
it eventually got
we've
up.
done the same thing
We
where
did we did fine on all the houses that we sold. We just had to wait. Matter of fact, we did good on the last two I sold. I didn't sell them because they were such good rental houses.
yeah,
But
100%.
at the time, I was buried in them. I couldn't get out of them. I was like, "When just going to rent these houses?" We rented them out, and they sold for 2.5 times what we had into them last year. So it was worked out good.
Okay, and if you have a couple more minutes,
Yeah.
just want to see. So, where do you think interest rates are going to go? Because I did a poll on this, and there were some people voting the tens. Most were in the 6s and 7s, but where are you thinking? Maybe like 30 seconds there.
Yeah, I would. I don't hope we don't get to the tens. It's very hard to predict interest rates. But right now we're right around 5 on a primary, 6 on a 6.5, something like that on investment property. I could easily see primary rates going up to 6 or 7. Maybe even mid 7s. Investment rates maybe 8 or 9 sometime. Unless they get a handle on inflation. As long as inflation is where it is, they're going to keep raising rates. They have to. That's the only way to combat it.
Yeah, absolutely. Thank you so much, Daryl. Look forward to connecting with you soon.
Yeah, you too. Good to see you, Chris.